Very, very excited today for this month's guest speaker. Just some intro. Through his company, Casmon Capital Group, he's partnered with investors on over 900 units valued at over $90 million. He is the host of podcast Target Market Insights, host of the Chicago Multifamily Club Meetup. He is the co-creator of the Midwest Real Estate Networking Summit, which is the birthplace of Windy City REI. And he is the marketing master and real estate entrepreneur, John Casmon. Woo! We are excited to have you.
Listen, April and Julian, I'm excited to be here. Thank you for the invitation, and I'm excited to talk today. So, first of all, I gotta thank you for the warm introduction. I'm so excited that you guys launched this, especially coming out of the Midwest Summit. I know we had a few interactions during that event, and you all were very excited to kind of just take that next step in. And a part of this big thing is taking action. So I'm glad you guys were able to do that. We've got 17 or so people on here right now. So excited for the discussion. You guys have any questions for me before I jump into things or what here?
Oh, I think we're just so excited.
Yeah, we're so ready.
All right. Well, look, let's hop into it. Okay. I did put together a presentation. When we were talking about this, do you guys want to grant me access, or do I have access to present? All right, cool. All right. So as you do that, I was going back and forth with, give you guys some background. I've been talking to April and Julian kind of separately, and part of it is just like I run like kind of a million miles a minute, get the ball, dish it, what I got to do. Okay. So I do a lot of that. And what happened was, I think I was talking to April on Facebook, like through Facebook Messenger, and Julian through LinkedIn. So I would have an interaction and kind of forget it was for the same event. Or then when I realized it was the same event, I kind of forgot what I'd already talked to Julian about. So April was like, yeah, I think Julian talked to you about that. I was like, oh, that's right. Okay, let me go check that platform. And then the emails were coming from the Windy City REI, which was basically gone to my promotions tab. So I'm like, no, I didn't see an email. I have no idea what you're talking about. So anyway, I'm glad they both kind of stayed on me. We were able to figure it out, and here we are today.
I know we can get to him. You get to him from here. I'll get to him from here.
Just gotta attack him from different angles.
We'll just keep bombarding him.
The thing is, I'm pretty accessible. I responded to both of you. It was just a matter of the email got lost. So I just missed the Windy City REI. I was expecting it from April or Julian. So when it came from Windy City REI, I got flagged and I missed it. But either way, we're here. One of the things that you all told me you want to talk about was really how to select markets. So that's what we're going to talk about today, is how to pick markets. Just by a quick, just in the chat box, help me understand where everyone is at. If you're trying to figure out either the next market or neighborhood to invest in, can you just put a 1 in the chat box so I could get a sense of where everyone's at right now? You don't have to tell me the exact neighborhood, just that you're trying to figure it out.
No, okay.
Yeah. If you're looking to figure out the next neighborhood, just put a 1 in there. There you go. I see a few familiar names, so that's great. Okay, cool. All right, so what we're going to do is I'm going to walk you through a little bit about our process, and you'll get a sense of kind of my journey, what I figured out, and hopefully this is pretty valuable and informational for you guys as well. All right, so let me share my screen here, and we will jump into this thing. Can you guys see the finding the best markets and submarkets?
Yep.
All right. Is there a, how do I do this? Nope. Is there a way to put this just so the video's to the side?
Let me see here.
You know what I mean?
So that way your face isn't it, and this is just a full screen thing.
Yeah, because otherwise what'll happen is wherever I put this box, it'll basically block that part of the screen.
Did that do it right there for you guys?
Oops, slides are just going. Look at that. All right. Don't worry about it. I will make it work. I don't put stuff in the upper right corner for that reason. So, yep, there we go. You guys see everything okay?
Yep.
I'm on mobile and it looks fine.
Great. All right, let's move. All right, so let's keep moving here. All right, this is finding the best markets and submarkets. Very first thing, when you talk about how to find the best places to invest, Most people have heard that the number one rule of real estate is location, location, location. As a matter of fact, this is, if you go back to my earlier podcast episodes, it's how we start the show, right? Location is the number one rule of real estate. How many people have heard this? Just put a 2 in the chat box real quick so I can see that. Okay. Cool. Excellent. Excellent. A lot of people in here. All right. So this is a great quote. Love this quote a lot. But that's not really the thing you need if you're looking to find the best places to invest. And there's a big reason why. Okay. Part of this thing is you have to understand time. Time is really important. If you were investing in downtown Chicago 100 years ago, probably would have been an amazing place to invest. Same with Lakeview, Lincoln Park. You get my point. Part of it is you have to understand the timing of things. And since we can't go back and invest 50 years ago or 100 years ago, what we're really trying to do is figure out where the best places to be investing based on today's current value and where things are going. Okay. So understanding that location plus time, those are the real key things that you need to understand success. Okay. So a better quote is don't wait to buy real estate and wait. Okay. So that's what I want you to think about if you're at the beginning of your journey and you're trying to figure out the best places to invest and you're trying to figure out all these different things. Just make sure you get started. Okay. Buy the real estate. And if you have a long projection, you're going to be okay. Okay. So just understand those things there. All right, so we're going to cover a couple of things here. So what we're going to talk about is the criteria for selecting a market. We're going to talk about identifying growing submarkets. I have a few resources that we're going to share, and then I'm going to give you some best hacks to find these locations. First, I want to give you a little bit about me. Okay, so my background is was in marketing prior to getting into real estate. I'm a father. You guys saw me kind of just pause this to go make sure my kid was all situated. Husband, a syndicator, a marketer, podcast host, and also a coach. Like everyone else, I wear different hats. And like most people, I'm looking to invest in real estate to streamline the things that I have to do and focus on the priorities that I have for myself. I've partnered with other investors to get into over 900 units, valued at close to $90 million. April mentioned the podcast is called Target Market Insights. It's a multifamily marketing show. We'll talk a little bit about it more later. And then I'm a co-creator of the Midwest Real Estate Networking Summit, where I actually met Julian and April in the first place. Okay. But you kind of have to run the clock back. All right. So before really building up the real estate portfolio, I was a full-time marketing executive. And the challenges that I faced in that space were really just watching what was going on around me. You go back about, 12, 13 years. I was at General Motors when we went into bankruptcy, and I went through multiple rounds of layoffs and went through that structured bankruptcy. I was at an advertising agency that also went through some financial hardships and ended up having the doors closed on that. And we had a round of layoffs and had a lot of instability. And what all those things taught me was you just cannot depend on a W-2 job. I watched my father go through strikes and, being a blue collar employee and going through strikes and changing jobs. It was just something that I recognized you just lose power. And as an employee, you don't have power. It doesn't matter how great you are. I mean, there's some great events and some pictures of some of the activations I was a part of, whether it be, working with magazines like Essence or, in the bottom left-hand corner, you see a picture of me and Marcus Samuelson and the entire team. We did, photo shoots with Pussycat dolls and I mean, just plenty of fun, great activations. But at the end of the day, I was an employee. And at any moment, I could no longer be somebody's guy or the role could be eliminated. And here I am trying to figure out how to take care of my family. So for me, real estate really created the insurance that I was looking for, just the insurance and the potential to create some freedom. But to get started was a little bit more of a challenge. I mean, there are three things that I really struggled with: figuring out one, where to invest, figuring out which data points were most important, and then last, figuring out the areas that were poised for growth. I mean, I read a lot of books. I listened to, really podcasts weren't out at that time, but I read a lot of books. I read articles. I attended events, but I couldn't get that clarity to help me figure out where to find the best places to invest. Okay. So my very first deal, I moved from Detroit to Chicago in 2011, and I decided, hey, this is where we're going to go. I'm going to move to Chicago. We're going to figure out where to invest, and we're going to start building our portfolio, right? So in 2012, I bought a 2-unit property in North Center Chicago. I'm not sure how many people are in Chicago. I think most people are. But we house hacked. So we lived in that property for almost 7 years up until I moved to Cincinnati 2 years ago. We made over $200,000 on that deal. So it was a great deal. But how did we figure out North Center was the place we wanted to invest in? Let's talk about it. First of all, I did a ton of research, and out of all the research, something jumped out at me. All right, this is from the Chicago Magazine, and there was an article from April 12th, 2012, and it was about Chicago home prices and trends. So at this moment, I've been seriously looking for about 3 months. I come across this article, and I scroll through. They have 70 neighborhoods on here, right? And out of the 70 neighborhoods that they tracked, the only one that was virtually flat, right? I put didn't lose value, but you see since 2006, it's down 0.79%. Compared to all the other numbers you see on that screen, if you're looking at the column here, change since 2006, since all the rest of them are pretty much double digits, I think it's fair to say that it didn't lose any value, right? And just keep in mind, again, that time frame. We're talking about 2012, coming out of, the big loss in 2006, 2010, that just jumped out to me as like, look, if this didn't lose any value or any real value from 2006, given everything that just happened in the world, it's probably the best bet from a neighborhood standpoint. So I stopped doing any other research when I saw this stat. I mean, to me, this was neon arrows just telling you invest here, pick here. So I stopped doing research, right? And we bought that 2 unit that I just showed. It went extremely well, and I was very pleased. Now I will tell you, it was never this easy again. At no point did I look at a list and see everything pointing me to a specific neighborhood. So it got a little bit more tricky. The next deal we did was a 3 unit in Chicago, in Avondale. Shortly thereafter, about 2 years later, we bought an 8 unit in Hermosa, bought a 28 unit in Cincinnati. We did 192 units in San Antonio, Texas, and they did 3 more 100+ unit apartment complexes. And we can talk about that a little bit later. The thing I want to focus in on, though, is really after that 2 unit, part of what happened for me was to step back and say, okay, I looked at the same kind of data. I looked for the same kind of neon signs. They didn't exist. I didn't see them. And I tried to figure out where we thought the next opportunity could be. Because North Center by that point had gotten pretty expensive, and it just wasn't as affordable as it was when we bought in 2012. So I locked in on Logan Square. And I thought Logan Square would be the perfect place for our next investment. The only challenge is the numbers didn't work quite as well. We couldn't get quite the cash flow we were looking for, but I looked a little west of Logan Square in Avondale. And we thought Avondale was a great market. It had a lot of the same characteristics as Logan Square. So we bought this 3 unit there. That did great for us as well. The 8 unit in Chicago was a similar thing. We kept looking in that Logan Square, Avondale area, trying to look, in those areas close to the northwest side, and locked in on Hermosa. And we always really had this process to follow those neighborhoods. The thing though is that as we scaled our portfolio, we had to loosen up our parameters. Went from being really focused on very desirable locations where it's close to the train and all of these other things. And as we loosened it up, we got a little further away from a lot of those different criteria. And what I want to talk about is the mistake I actually made on my 8 unit in Hermosa. So this is our first commercial property. We did the 2 unit, we did the 3 unit property. Now we want to go commercial, right? We want to go commercial. We want to use a third party management company to gain that experience. And as we change neighborhoods from Avondale out further to Hermosa, now we were dealing with some residents who were on Section 8, and I'd never dealt with Section 8 or CHA. So we got a lot of first time challenges that we're dealing with here. And it took a minute to figure out how to navigate those things because you don't know what you don't know. And one of the most important things you can do is be resourceful and put yourself in a position to go and get the resources that you need. This property had a lot of operational challenges. I mean, we had something where I didn't even know what a lintel was, but we had a cracked lintel. The inspector came out, flagged us for it, and it cost me like almost $12,000 to get this lintel fixed. Well, it wasn't just the lintel, but it was the lintel and kind of everything else that we had to do. The total bill was around $12,000. There was a resident, and when we bought the property, the seller told us, "Hey, you've got a resident in this unit here, and she makes up every excuse in the world to not pay rent." And he told us that last month she said that there was a ghost living in her apartment, and she couldn't pay rent because of this ghost. And you know what I learned? Ghosts don't pay rent. So here we are with this apartment. I can't figure out this lady for anything. She's got all sorts of issues. Will not even let us in the unit. Is refusing to pay rent. And as you know, Chicago's not exactly the easiest place to do evictions and things like that. So it was a challenge for us to navigate that. Nonetheless, we figured out a lot of those things and we were able to work on the operations. However, life happened and we had other priorities. We had other opportunities that we wanted to move into. And we looked at this deal and said, hey, we can wait it out until we get everything turned around and drive up the operations and the NOI, or do we want to just say, look, you know what, let's just cut our losses now and let's move on and find some better opportunities. After about 2 years, we decided to go ahead and sell the property. We pretty much broke even. We made a fraction, but we didn't make much money on this deal. And I think the biggest thing is this. It goes back to where I started the presentation, right? We didn't factor in the time component enough. Avondale was right there on the cusp. You know, it was months, if not a year or two away from becoming kind of what most people know the Avondale neighborhood to be now. This neighborhood, on the other hand, it needed more time. It was not quite on the cusp. It needed more time. It wasn't as close to the trains. So we really needed to be more patient because this was more of a blue collar, hardworking neighborhood versus Avondale, which I think was very similar to Logan Square in a lot of perspectives there. Okay. All right. So as you step back and you have those experiences, you need to learn, not just from the wins, but also from the projects that don't work out as well. So starting out, I was really making educated guesses, looking at the information that I had available, looking at the data, figuring out, the market was easy because I was going to invest in Chicago. But as I started to move out of our market, out of the city, looking at Cincinnati, looking in Texas with some other partners, that's where I really had to go from just making educated guesses to really trying to streamline a process, something that was more of a system that we can kind of replicate. I ended up launching my podcast at that time. So it's Target Market Insights, multifamily marketing show. And I did so for one reason. I wanted to learn how other investors were finding the best places to invest themselves. What tricks were they using? What insights did they have? What numbers did they pay attention to? I really wanted to understand how they were able to identify those best places, use their criteria, and grow from it. So if you go back and listen to, I don't know, maybe the first 60 or 70 episodes, they're pretty much just about market research, asking people about, where they invest, tell me about the city, tell me about the market, what side of town is more ideal, where can you get better rents, all of those kind of things, where's development taking place, just really trying to understand the metrics and the numbers that people are using to find these best places to invest. And I will tell you that from doing over 270 episodes, we figured out a great process there. But more importantly, we've evolved the show to be from just market research to really all of the marketing elements that someone needs. So if you're looking for some of that information, check out the show. It's on Apple Podcasts or anywhere that you listen to podcasts. But check it out. It's filled with great information, especially if you want to go back and learn more about the stuff we're talking about right now. Okay. All right. So I got to say, you might be asking yourself, all right, cool, great. That's great for you, John. Now, how do I find my target market? Right. It's time to take a lot of this stuff and let's put it into action. So first, I got to challenge you guys. And no matter where you are right now as an investor, if you are in the early stages, trying to figure out what neighborhoods you're going to invest in, or you're just looking for your next deal, one of the things I want you to do coming out of this presentation is to select your target market or your target neighborhood in the next 10 days. All right. So if you're up for the challenge, do that for yourself. I think this is going to help you just take this information, put a timeline on it, and make sure you take action. So, one of the things that really separates the people I know who have success from the people who, maybe don't move as quickly say take action. I mean, I started off by talking about, this meetup. There were a lot of people who attended our real estate event, our conference. Very few of them decided, you know what, let's launch a meetup right afterwards. So if you want to separate yourself, it's not from the thinking, it's not from listening, it's from taking action. One thing I need you to understand too is you can't expect to find the perfect neighborhood. Just like I was kind of misled with how easy it was the first time with North Center, there will not be neon signs pointing to a neighborhood telling you this is the absolutely the place you need to go to. So don't look for perfect, look for things that confirm, hey, there's probably an opportunity here. The next thing is you can read books, you can listen to podcasts, watch presentations, and do all these other things. But you're not a real estate investor until you invest in real estate. So make sure you're focusing on taking the necessary action to get those results. And then last, I would say, look, you're never going to know everything about a market. You're never going to know everything about a property or a deal. So get 80% of the information and get very confident in what you're doing, but take action and then continue to seek out more information. More importantly, become resourceful so you know where to go to get information as you need it. Okay. Now, let's talk about some actionable steps for you. First thing up, okay? Determine your investing criteria. Okay. What are your goals? What are you trying to accomplish? What kind of returns do you need? What asset class do you want to invest in? Do you want class A luxury properties, or are you looking at working class, class B, class C type products? So you've got to figure out what kind of properties and neighborhoods do you actually want to invest in. Are you looking more for cash flow? Are you looking to do a value add play? Or are you simply looking for long term appreciation? You got to figure out what's most important to you. And if you're looking for a blend of all three, then you're probably looking at more of a B class type property, right? Something where there's enough cash flow today to cover the bills and make a decent return, but you're hoping that over the long haul, there's going to be enough demand for that property in the future that you're going to have a asset that appreciates. I would tell everyone to start with your backyard. Before you start looking all over the place for deals and opportunities, look in your own backyard. If your area is not ideal, then ask yourself, are there areas that are close to you that make sense based on the criteria we just laid out? Are there areas that you're familiar with? So maybe you live downtown Chicago right now, and that may not be ideal for you to invest. But if you went to school in, say, Indianapolis, maybe you should think about Indianapolis, or maybe you have family somewhere else. So, what areas are you familiar with? And think about those markets. And then, last, where do you have boots on the ground? If you've got friends and family in a market, especially if it's one you travel to frequently, think about that because you're going to be in these markets and you need to check on your investments. So, you may want to focus on places where you have some connections already. All right. And then the last thing I would say, as you look to go outside of your core markets, you should find areas that really meet most of your criteria. If you're not going to invest in your backyard, don't just invest in some random city because you're familiar with it. At that point, really make sure it has some of the key criteria that you're looking for. And we're going to jump into some of those things right now. But you definitely want to make sure you're familiar with the market. And then as you're investing in these markets, you really want to lock in on the path of progress because you're not going to know everything there is to know about a new city. So if you can find a place where the demand is actually moving towards, that's going to eliminate most of the risk for you. All right. So here are 6 things that I think are really important. And this is from all of my conversations from the major multifamily investors across the country. But these are 6 traits that every investor looks for. Okay. First is population growth. Is this market growing or is it stagnant? And if it's stagnant, that's not bad either. But if it's declining, that may be more concerning. You want to understand what's going on from a population growth. Right after population growth is job growth. Are there new employers moving here? Are there jobs coming here? What's going on there? And to find this information, you can go to the Bureau of Labor. So you really want to make sure you're investing in a place where you see jobs increasing because people follow jobs. All right. It's just a really simple philosophy, but people follow jobs. So if you invest in places that are seeing job growth, you're going to see more demand and more people moving there as well. You also want industry diversification. You don't want to be in a place where one industry makes up more than a quarter of all the jobs. Think about Detroit. I was living in Detroit at the time. The automotive industry was such a big player that it brought down the entire city because you didn't have other industries that could keep the city afloat. So you definitely want to make sure that it's not just tied to one industry. Right now, tourism might be a big issue, right? If you're looking at, let's say, Las Vegas, with everything shut down for a while, if your entire city or MSA is driven, I shouldn't say entire, but if a big chunk of that MSA's jobs is driven by tourism, well, you can imagine what happens when tourism drives up. So you don't want to have any one industry driving, the MSA there. The fourth thing, and this is where it gets a little interesting, you're looking for affordability. Why? Because people need to be able to pay the rent, and those folks who invest on the West Coast, there's nothing wrong with that. But if your residents can't afford to live there, then they're going to eventually seek places where they can afford to live. So you have those issues. And in the Midwest, we're lucky because most of the Midwest is pretty affordable. So it's a win-win situation for both the residents as well as for us as investors because we can get good cash flow based on that. We also want landlord-friendly markets just because we want a place where it's easier to do business. There's nothing wrong with being in a place where it's less landlord-friendly. It's just going to be harder to do business. So, and ultimately, that's all we're trying to do is make sure we make investment decisions that make our job easier. And then the last is you really want to make sure that there's demand for the properties. Ultimately, I'm looking at new developments. I'm looking at absorptions. I'm looking at stuff like that. Might get a little tricky if you're not, deep into this space. So what I would tell you is this: are rents going up or are rents going down? And that's going to tell you the story. If rents are going up, then that tells you, okay, there's strong demand here. If rents are going down, that means there might be either oversupply or you're concerned that there's lack of demand for some other reason. Okay. I just got a couple more slides here. One is when you're looking for the best submarkets, one of the tricks is think about it from a renter's perspective. What are things they want? Well, they might want to go downtown. So, how close is this thing to downtown? What are the schools like? What is the transportation or the train system like? How close is it to the trains? How close is it to a highway? What are the rest of the amenities in the community? Is it near a park? Is it near a lake? What else is in the community? Are there great restaurants there? What's the nightlife like? So you really want to understand what elements that make up of a submarket or neighborhood, and think about the residents you want to do business with. Who do you want to attract, and why would someone want to live there? There's nothing wrong with investing in a working class neighborhood. You just need to understand that it's a working class neighborhood versus if you're trying to invest in the next hot market where young folks and the folks in their 20s want to rent. That's going to be a different type of neighborhood and different types of vibes and characteristics you're going to look for. So you have to figure out what's right for your business plan and then use some of these traits to help you determine where that place might be. And then I think the other piece is, as we talked about when we started, it's not just location, location, location. It's really more about patience. And if you can find a good neighborhood and wait it out and let that neighborhood continue to develop and let the place continue to grow, then you're going to see great success. I have a couple resources here, more than a couple. I've got a lot of resources here, and I can put this up and make sure Julian and April have this as well. But whenever you're looking for economic data, I would start with government websites. So I'm looking at the U.S. Census, I'm looking at the Bureau of Labor Statistics, and then you can reach out to local groups like the Local Economic Development Council as well. And then if you're ever looking to find out, like, hey, what's going on with multifamily rents or trends, start with like the big brokerage firms, CBRE, Marcus and Millichap. They have a lot of great information, real pages, ALN data as well. So I always try to reach out to those individuals to find out, if they have any data, any market reports, and they can normally help you get a pretty good sense of which neighborhoods are changing or improving based on their metrics. Okay. I'm going to pause for questions and I want to open it up a little bit if that's okay. But I do have two downloads if you guys want to check this out. One is 35 hacks to find the best places to invest. Um, And then the other is our sample apartment deal package. So we have both of those available if you want to check those out. If you want, let me know, and I'll drop the links to that in the chat box. But I will stop sharing and open it up for some questions.
Don, that was extremely helpful. Thanks for that presentation. I think that's going to provide a lot of value to a lot of people over here today.
I
No
think
problem.
I think that the part that that I found really changing for me in terms of the mindset of choosing a location is the time aspect. I mean, we hear it all the time, location, location, location. But the way that you described your 8-unit, where it wasn't quite where Avondale was, I thought that was super interesting, because if you can time it properly, you can really get great cash flow and great appreciation in a neighborhood that people might not be looking at.
Looks like we have some people who raised their hands. I think Sven raised his hand first, and then Christina can follow. Sven or Christina or Alex have a question?
I'm sorry, I apologize. I unmuted Zoom, but I did not mute my phone. So let me try this again. Thank you so much for this presentation. It's wonderful. Curious if you have any thoughts for those of us who are who recently refinanced, are locked back into our a year, in our current residence, and what the trade-offs or strategies you think make sense. Should we be, for a lot of us who are looking at maybe doing a house hack, should we just be trying to build for when we're released from that limitation, or should we maybe thinking about investing out of state, or working with other people?
Yeah, I mean that's a tough question to answer without having more specifics on your situation. What I would say is this: whenever you're evaluating your investing strategy, you should get really clear on what your goals are. So, and know that you can't hit all of your goals with one deal, right? So get clear on what your goals are, and then I would ask myself, okay, does this strategy align with my goals? And to be clear, you can't just look at your investing goals. You have to look at your other lifestyle goals and your priorities. I'll give you my example, right? I told you guys that part of the reason I got into real estate was I wanted to insulate myself from potentially losing my job. Well, what ended up happening is I started getting the 3-unit, the 8-unit, and all these properties. And what I ended up doing was basically picking up a second job. So I now went from, hey, I want to be independent and I have to depend on work. And financially, we were certainly headed there, but I never wanted to get a second job. I was working a full-time job, and I had 2 little kids at that point. And here I was now working a second job. So my priorities had to shift to say, no, I want to be a present father as well. I want to be here to take care of my kids. I want to be able to do things with them. And when I found myself either running over to an apartment to do a showing or to check on something, or I'm out of town for work and something's happened with the property and I'm scrambling all over the place, I realized that didn't work. So I would say you also have to understand where you're at in your life, like how much time do you have to devote to this, as well as how much money you're planning on making or what your real investing goal is, and then devise a strategy that best positions you accordingly.
Alex and Christina, you guys want to go ahead and start?
Sure. John, thanks again. This has been fantastic. I wanted to kind of follow up on that last question. You mentioned, the blend between cash flow, appreciation, and value add. And I was wondering, what are your thoughts? What are you specifically looking for after you've done, 900 units or something? What do you typically focus on when you look at a deal, of those three? And how's that changed from when you started, and what was the thought process that kind of got you from one place to the other?
So it's going to be a little different for me because, I mean, we're doing apartment syndication, so we work with other investors who want to take full advantage of multifamily without becoming a landlord themselves. So I have kind of my deal metrics that I look for, as well as the investor return metrics that I know they need to feel comfortable doing a deal. So it's going to be a little bit different. What I will tell you, and you asked how my view has changed, I think that's probably more helpful. So the first deal, honestly, it was so simple and easy. And in a lot of ways, I tell anyone who has never done a deal to do it one of two ways: either a house hack if you can, or literally find a partner, whether that's through a syndication or just a JV deal, and partner up with somebody. Because I think those are the easiest ways to get into it. And part of what you have to do is not become the barrier yourself. You don't want to overthink so much that you never pull the trigger. And I think we can talk all these metrics all day long. What stops most people is the fear that they have that they're going to F up, right? It's just sitting here, you're analyzing, you're looking at stuff, and you're just fearful that you're going to make a massive mistake and you're going to lose your money. So I think if you can eliminate that thinking and that risk, it's going to make your investing much easier. So with the house hack, I was about to get kicked out. We were looking. I thought we wanted to do it, and we got a little trepid. And I asked my landlord, "Say, hey, man, we didn't find anything. I think we're just going to try to stay. Can we stay a few more months?" And he was like, "No." And we were like, "Oh, like really?" He was like, "No, man, my wife is pregnant, and it's like I want you to stay." But I asked her, and she said no. She said we need somebody who's going to commit to a full year. You guys only want to do 3 months. Like no. So like, damn. So I ended up looking at the properties on my list. I said, can we break even from what we're doing now? So I didn't even need the property to make money because I was going to live in one of the units. But if we moved out, I wanted it to be profitable. And while we were living there, I wanted to at least pay less than what I was paying in rent. So, I, I mean, we didn't go super deep with the criteria, right? I wanted to be in the neighborhood that I said. I knew I wanted to be in North Center, um, for the reasons we've already talked about. So, and I felt because we're going to be there, we were taking a long term view. I wasn't looking at, okay, in a 3-year hold, how much money will I make? It was like, will we have enough money to pay the bills? Great. And can I find a quality resident? And in that case of a house hack, it's not just a renter. I'm looking for a quality neighbor, right? So can I invest in a place where I'm actually comfortable with this person being my neighbor, not just, okay, they'll pay the bill. So North Center provided that. So that was great. When we did the 3 unit, that's where we got into, okay, it needs to make us $200 a unit in profit a month. So that was our going in criteria. And we also wanted to find something that had a little bit of upside. I didn't want to do any work. I didn't want to pick up hammers, or anything like that. But if it was an operational upside, that's what we were really looking for. We found this 3 unit. It was off market through the agent. The agent represented both sides. She said, look, I'm going to list this next week. But as I'm talking to you more and more, I think this is exactly what you're looking for. I looked at it one time, I was like, you are absolutely right. And she's like, okay, let me call the owner because I don't even know how to do this between both of you guys. So he and I spoke. We probably had one round of negotiations, and we got the thing under contract, and we made 6 figures on that deal ourselves. When we got to the 8 unit, again, every time it got harder and harder for us. So when we got to the 8 unit, now we're in a different neighborhood completely. I started looking more like now I'm starting to be like professional, right? So now I'm looking at the gross rent multiplier and the cap rate, and I'm looking at all this other stuff, right? Because this is a commercial property. I know I can't mess this one up. So we look at all these things, and I sat with the broker. We had a lot of conversations about it. It was able to, on paper, it delivered that $200 a month return that we were looking for. But again, I would say that there's the paper stuff, and then there's like the reality. And I would say, if it's just you and you're investing, don't get so caught up with whatever those return metrics are, because I think buying a better asset or in a better location is more important than buying a property because it has a 1% higher cash on cash return than this other property you're looking at. I'd rather buy a better piece of real estate in a better neighborhood, than buy based off of the returns, because it's easier to force your own returns if you're buying based on either lowering your expenses or creating demand from the rental market. I can't make people want to put Hermosa on their criteria, right? I can't make people look up, hey, apartments in Hermosa, right? I couldn't force that. People are naturally doing that for Avondale. So I just had to look and be like, oh, okay, hey, based on my research, I think this is undervalued. I couldn't do that in another neighborhood. So figure out your competitive advantage is what I would say, and try to invest in the best neighborhoods you can.
All right, Alex has a question up next.
Awesome. Yeah, thanks, John, for the presentation. This was great. I guess my question is related to, if you're looking at a market, say you're looking for something less than 100 units, like maybe somewhere from like 5 to like 75 or something, and you have more contacts in like a Midwest region, like you live in Ohio, so you know more people in that area. How like heavily do you weigh that versus going to the South, like to Texas or something? I'm sure it's different with syndications, but if you're not doing a full syndication, maybe you have like a few partners. How do you I guess it's like sort of a specific question, but how do you like choose whether or not to weight that heavily? Like, I know more people here versus like this market might be a better market overall.
Yeah, great question. That's a phenomenal question, actually. I think it depends on two things. One, what's your role? If you are the lead person, if you're going to oversee the deal, you better know what you're doing. Right. So for me, when I invest in a Texas deal, I'm not the lead person. I invest along somebody who knows that Texas market, and I'm more of a general partner in that capacity. My local deals that are within a 2-hour radius of me, that's where we play more of a lead role because I'm more familiar with those markets. So there's only so much you can learn, especially on a computer, right? You can talk to people, you can certainly get out and drive a neighborhood and things like that, but you're just inherently not going to know everything about a market unless you've lived it, or you have strong ties where people can tell you, hey, this is how a market breaks down. When I launched the show, that's exactly what I was trying to figure out. And you can learn a neighborhood at that level if you talk to enough people. But that doesn't help you figure out the nuances, because some markets are street by street. So even if you know, okay, this is a solid neighborhood, you might wind up with a property on the wrong side of the street. I'll go back to North Center, and North Center is a great area, right? More of a Class A location. My place was on Bradley, the street just south of me, the next street over. Um, the side of the street that was on the north side was in the Bell School District. That side of the street, the other side of the street, was in a different school district. The Bell School District was more highly rated. If someone bought on the same street but on the wrong side, they would have been really upset when they found out that they were not in the Bell School District and were not sending their kids to one of the top rated elementary schools in the state of Illinois and Chicago. So some of that is like, I don't know how you learn that. Like, you know what I mean? Like, I don't know how there's no book that teaches you that. Obviously, you want to check out the school districts and all of that, but there's so many layers to it. You have to understand how school districts work. How do you get selected for school? Is it based on location? Is it lottery? Is it like, there's so many things there. So what I would tell you is try to eliminate as much of that risk or additional, knowledge gaps as possible by either partnering with somebody or bringing somebody on who has that knowledge and experience, or finding other ways to eliminate it. But I mean, just going to Texas, how many other people are looking at the same data and running to Texas? That was my thing, was like, I can read just like you. So if we both see Dallas is a #1 rated market, what's going to give me a competitive advantage over the guy who lives in Dallas? So why would I think I can do it better? And I'm not saying I could or couldn't. I'm just saying it made more sense to me to focus on markets where I had stronger ties, and I didn't have to spend that time researching the market. I could just see where the address was, underwrite, put in my offer, versus, okay, let's go learn about Dallas. Like, no, let's just do what we know.
That's a great answer. Cool. Thank you.
Yeah, absolutely.
All right, we got Aaron next.
Hey, Aaron.
Yeah, thanks for the presentation. As always, you always provide a lot of content and a lot of useful content and stuff that I'm thinking about now. So now from the 3-unit in Avondale to like buying like the first commercial property with the A+ to now your syndications, what's kind of like the biggest like step or leap to get to that point?
To where we're at now, or to the 8-unit, or which
Yeah,
point?
I guess first the 8, like the 8-unit.
So, I mean, listen, I think the biggest thing for us was surrounding ourselves with people who were in the space. You got like the fact that we're able to do this now is amazing because this was not an option. Like I'm starting to feel old, you know what I mean? Like it's just crazy because I always listen to old people talk and see, I said it. I listen to older people talk, and they talk about investing. It's like, why to go get books and look at the newspaper? And I'm like, damn, dude, like, like we had the internet at least, but we didn't have meetups and these Zooms we could just hop on and talk to people. That wasn't there, right? So I think the way technology works is it continues to make it easier and easier and easier. I used to have to physically get in the car, travel, and I would go to Lisle and St. Charles and all over Chicagoland to just be around other investors because I didn't know anybody who was investing. So I kept having to just make sure I wasn't crazy, and I was young in my late 20s, early 30s. So for me, it was like, am I gonna lose? Is this a scam? Am I gonna lose all my money? Like, I know I read this book, but I don't know who the hell these people are. Like, are they even real people who write these books? Is this like you just start going through these things in your head. And for me to physically be around people and meet them when they had 1 3 unit building and watch that person. And I'll tell you, this is Bree Schmidt. If you guys know who Bree is, she's a close friend of mine. And I met Bree fairly early into her investing. I think she had 4 units or something like that when I met her. She had I think her place and a 3 unit or something, and we hadn't bought anything yet. And I think in the first year, I saw Bree get up to 9 units. And I was like, damn, that's impressive. Bree, this man, she went to 9 units. The next year, she went up to I think 89 units, and I stepped back and I said, "What? How, like you're playing a video game, like you're cheating. Like I don't understand how this works." So I sat down with her and I said, and I'm not like Mr. Social like that. I mean, I can be, but that's not my thing. But I was floored because I was like, I just talked to you like 6 months ago and you had 9 units and now you have 90. What happened? What did I miss? Did you hit the lottery? Like I'm confused. So we sat, we had lunch or breakfast, and because we lived in the same neighborhood, and we had breakfast, and she told me she basically had brought on some partners, and her partners are like, here's we got our money, just go find us deals. And so she was able to expand big time. And I don't know if I ever would have started to think like that without having someone that I watched expand their portfolio with that kind of speed. Because again, I would have just chalked it up to there's something that person has that I don't have. You don't go from 9 to 90 in a year. Like that's some bullshit. You know what I mean? You don't go from 9 to 90 in a year. It's a fraud, it's a scam, whatever, right? All of my antennas would have went off. I'm a savvy dude. I've been in corporate America, oversaw $100 million advertising budget. You're not gonna pull something over me like that, right? I'm not that smart. Like, I went to a state college, but I'm not that dumb. You know what I mean? And but just having those conversations with real people where you knew it was like, oh shit, this is actually real. This is possible. I know people who are doing this. Okay. And so we sat and I was like, well, how'd you do it? Well, here's what I did. I did this, I did that, I did this. I said, okay. And I called a few other people that I knew and they were like, I did this, I did that, I did this. I said, oh, okay, cool. So I started to do this, I did that, and I did this. And I bought the 8 unit. The moment I bought the 8 unit building, that was November 2016. The next month, I was it November 16? Yeah, it was 16 because my son was born. The next month, I met Joe Fairless, and he was not the guy you probably know now, but he had done one deal. He bought a 155 unit apartment complex in Cincinnati at that time. I met him for lunch. We had a great lunch. He told me he was mentoring people on how to do it. I said, cool. I signed up. Um, and then I watched what he started doing. You know what I mean? So I can't stress the networking enough. I can't stress whether it's formal coaching or mentorship or having people that you really trust who can coach you and help you along the way. I think it is the most important aspect of it because you need that positive reinforcement. You will mess something up. You will fail at something. You will not catch something and you're going to have those issues. That's not like people used to always tell me, don't worry about it, fail forward. I'm like, that shit sounds great. When you read the story afterwards, right? When you're in the middle of it, you're like, I'm going to die. I'm going to die. I don't know where the money's going to come at to pay the mortgage this month. Like, it can be tough, right? But when you have those people around you, it just, it lets you just stay grounded, right? You can bounce it off of them, and then you hear them tell their stories, and they're like, oh yeah, dude, I lost $100,000 on that deal. I'm like, you lost 100,000. Like, I'm like, whoa, dude, like I ain't lose. Like, so it just, you got to surround yourself with the right people. So I mean, more than anything else, whether you hire someone, which I think is a great step, or you build a network of folks, but you got to align yourself with people who are a couple steps ahead of where you're at. I think the thing for me with my mentorship was great was I wasn't working with the guy who had $1 billion portfolio at the time. I was working with the guy who had syndicated, a couple apartment buildings. So he could kind of relate to and understood where I was at. And even like us, I mean, the great thing is like in many respects, we are still very early in what we're doing. Like, I mean, we're 4 years into this basically from the business now. I mean, that first 2 unit was back in 2012, but we didn't start working with other people until about 4 or 5 years ago. So I think that there's a lot to learn still from that standpoint.
All right, we have another question here from Daniel.
Hey, Daniel. I'll try to keep my answers shorter, by the way.
Oh, looks like he chimed off here. Zach is next. What's up, Zach?
Hey, what's going on, Chris? Thanks again, John, for the fantastic info. Two quick questions. I guess taking it a step further. Let's say you found your market and you're starting to evaluate submarkets. Is there an order in which you use the criteria you outlined to find that best submarket? As I think about it, I would think you would start with the affordability factor and making sure that the numbers work, and then evaluating everything else like the safety of the neighborhood, the nightlife, the transportation, et cetera. But wanted to get your thoughts on that as well. And then when you're looking at that affordability, are you mainly looking at price to rent ratio, or are there other factors that you're considering as well?
Great questions. A couple things there. You got to get your own investment criteria first, because everything is subjective,
Right.
So I would start with what's your investing criteria, and then based on the returns you're looking to get, which areas can deliver on that. So I think that is critical, because let's go back to North Center. It's a great neighborhood. The problem is I could no longer get the returns I was looking for in North Center. It was an anomaly that I could get in 2012, right? And I probably could have gotten it up to maybe 2013, maybe early 14, but I wasn't getting it after that. So start with that, and then you have to go shopping, right? You've got, okay, hey, I've got, for instance, you might have it might be based on your budget. You might say, I got $100,000. All right, what can I go get for $100,000, right? So I think you've got to start with that. What will you take? What won't you take? What kind of resident base are you looking for? All of those things. So get that criteria tight. Once you have that, then I would start with broker conversations and say, hey, here's what I'm looking for. What areas do you think I should be looking at? Where do you see growth happening? Where are you seeing more people moving to? Where are you seeing more investors developing? And that'll give you a sense. Check out the very first episode I ever did of Target Market Insights. I don't know if it's good. I'm scared to go back and listen to it, because obviously after you do 270 episodes, you probably cringe if you hear the production and the questions you ask in the first one. But I had a script, and it was a very selfish episode. It was about Cincinnati. I knew I was going to be investing here, and I asked him every question I wanted to know about how to find where to invest in Cincinnati. He answered all my questions, and I almost didn't even want to do any more episodes, because I'm like, cool, you answered my questions, I'm good. I don't need to do this show anymore. And and I'll tell you, he said two things, and I don't remember the exact question I asked him, but um, it was the Montgomery corridor is what he called out. And part of what he said, and what I remember, is he talked about the development that was taking place. And I had never heard the term path of progress before he said it. So it stuck with me. But the point was, you take a look at the neighborhoods that are hot. What's everybody talking about, right? Like what's the hot neighborhood? What's going on with it? Now, why is it hot? What's driving it? Can you find another neighborhood that has other things going on and almost like make 2 points? That's the path of progress, right? Like, will they converge at some point? And sometimes it's cities. So, like down here, you got Cincinnati and Dayton. So between Cincinnati and Dayton, so let's just say northeast, right? Northeast suburbs of Cincinnati down to southwest Dayton. As jobs and development takes place further out, these two markets are going to converge. Same thing with San Antonio and Austin. So it's a similar mindset. In Chicago, the trains are huge. So I would start by saying, look at the trains. Just put the train map up. Literally put the train map up. And then make sure if you could be in walking distance to a train, that's probably a great place to start. And then figure out, okay, now let's talk about any of those actual metrics where people are moving to and affordability and all that stuff. But if people are close to trains, think about it from a renter standpoint. That's why, like when I moved to Chicago, that was my first question. How close is your train? All right, because if I got to carry groceries, more than like 2 blocks, it's not gonna work. So I was looking at the train. I was looking at, okay, it's the bus, but train was priority. And then you get into other, nightlife and other restaurants and all that other stuff, right? So I would start with that, and then you look to see like, okay, the problem though with that, what I just said is that's great for if you invested before. So now you want to see where things are headed, and to see where things are headed, that's when you start looking into what's being developed. Or I know the Green Line in particular in Chicago, they were developing a new stop. I'm assuming that's done by now, but I know the Green Line and the Pink Line, they were opening up a new stop. When I moved to Chicago in 2011, I worked in the West Loop, so I watched the West Loop go from the meatpacking district essentially to my office. We got priced out of our office building, so we moved. And then I watched I forgot who moved in first, but eventually Google moved in, right? And it was like, oh, but by the time that happened, it was like, oh yeah, it's too late. But when they moved, they ran that I think the green and pink line. There was no stop down there before. And the train ran right past us. So it ran there, but there was no stop there. So they added a stop. And I knew the moment they opened that stop, it was a wrap. That whole area is gonna blow up. So I mean, that's something I would keep my eye on if I'm looking in Chicago too. Is like, hey, what's the infrastructure development? Are they adding new exit? You can also, I have one of these hacks in my the download, but look at the other developers, particularly like a Chipotle or Whole Foods, Trader Joe's, companies like that. Where are they? And again, it's got to align with your demographic, but just go to their website and just see, like, you can Google, hey, where are they opening stores? Where are they opening up locations? And just look, if Panera Bread or one of those companies is opening up, I'm doing my research. I'm going wherever y'all go. so that's another little cheat sheet.
That makes sense. Thanks, John.
Cool.
All right, looks like Daniel's back on. Daniel, you want to try asking your question?
Yeah. So mine was just a quick comment about something he said at the beginning about just getting started. I don't know if it was on Bigger Pockets or if it was a podcast or something, but they said, you're not going to make, $1 billion off your first deal, but the stuff you'll learn will help you on all your other deals going forward. And so it's like, once you just get started, gets the ball rolling. And it's like, you're not going to strike it rich, but it's like, just do what you can, get in where you can, and just get the ball rolling. Kind of that exponential growth. It's like, just get started.
Yeah, I love it. And you're right. And I think the biggest thing too is that there's a different hurdle each time. We put these imaginary hurdles in front of us. Like, let's for instance say, hey, I want to get started, but I don't have the money. All right, well, how much money do you need? I just told you like that. I bought a 2-unit that was $362,000 with less than $10,000 out of my pocket. Right. So, and I probably could have got a loan, if I needed to. I probably could have borrowed money too. I mean, I have investors who are ready to put capital together. So maybe you can't raise $1 million today, but that doesn't mean you can't eventually raise $1 million. So I think part of it is that when you do the first deal, whatever hurdle stopping you from doing that deal, which is probably internal, once you get over that hurdle, you've now put in, you've built up, some positive wins. You've made a deposit to say, oh, I can do this. And then every deal, it just becomes easier. I mean, for me, it was very logical to go from a 2 unit to a 3 unit to an 8 unit. And then, we actually did the 192 unit before I did the 28 unit, but I did that with partners. So I kind of felt like I was leaning heavily on them, but then I did the 28 unit. So it, it's a matter of the steps, because you build confidence every move. And even when they don't go well, you learn from it. And you learn that, hey, you know what? I was probably more scared that this was going to go bad than once you're in it. If you've taken the time, you guys are all on here right now. So you're doing way more than most people. You didn't just wake up and decide to buy a piece of real estate because you saw it for sale on LoopNet and put an offer. You're educating yourself, you're building your team, you're surrounding yourself with folks who are more experienced. By doing those steps, you are taking the right steps forward. You're on bigger pockets. You're researching, and I don't think enough people give themselves credit for those things. Maybe you don't have experience being a real estate investor, but you've built up experience connecting, being resourceful, learning from other people, educating yourself. I mean, if you went to school for something, you didn't have experience doing it, but you went to class, you got a degree, you studied it, you maybe did an intern, you did all of these steps before you got there. So you have to recognize that and give yourself credit for it.
All right, John, we have a couple more questions here. We really value your time though. So I just want to make sure you're still okay for a couple more, or if you need to go in.
You got 8 minutes. You got 8 minutes.
Right on. Right on. Okay. So up next is Stacy. Stacy, you have a question?
Yes. Hi. Can you hear me?
I can.
You said you can?
I can, yes.
Okay. So my question is, I'm actively invested in a great market and I have a lot of local knowledge. Should I even consider looking into other markets, or should I focus my time on where I have kind of a niche, and work on building that and expanding that?
What problem are you trying to solve?
Probably creating more income with less time.
How does changing markets make that possible?
Pardon me?
How does a market change make that possible?
Possibly just reducing risk, as well as a different market I could set up more passively than something that I'm hands-on in my own area.
So what I would suggest is just think about what you're saying. I haven't heard, like, what you're talking about sounds like you might be able to do it in your own market as well, where you already have the knowledge. If that's not the case, feel free to correct me. But just because you're there doesn't mean you have to be active, right?
True.
I mean, if you're going to go and set up these systems and processes to be passive somewhere else, why not do the same thing in your own market, right? So now you can double dip, where you can decide, hey, this is a deal I want to be active on, or this is a deal that I like, but you know what? Plate's a little full. Let me go find a way to be passive. Because if it's in a market you already know, you probably already know a lot of other investors in that market. You probably have other connections, people who like what you're looking for. So like 80% of the legwork might already be set up.
That's an awesome point that I hadn't considered.
Yeah.
I think we tend to like focus, not delegate, because it's right there. But I think you're right. I could set it up passive where I'm at now.
And for context, when I started moving outside of my neighborhoods and out of Chicago, it was simply because I couldn't get the returns that I needed to bring on investors. Like, if I could have made the same amount of money, I never would have moved anywhere else, despite whatever challenges. But I could not deliver a double-digit return to another investor and still make enough money where it was worthwhile for me investing on the north side of Chicago. So that was the reason I had to start looking other places, because, and again, as the market got hotter and hotter and cap rates got compressed, I just couldn't find those returns for myself. So I had to start looking at more cash flow heavy markets, and scaling, quite frankly, because you can't do that on a 3 unit. I couldn't give you a 10% return on a 3 unit and have it be worth my time to make, like, $20 a month. Like it just like I wasn't gonna do that.
Yes,
So
okay.
make sure you're solving a real problem. And it sounds like the problem is how you get more passive on some of your investments as opposed to, just necessarily moving neighborhoods.
Awesome.
There are a couple of chat questions that I could probably answer really quickly. Sven says, having lived in North Center too and having targeted that neighborhood as a renter because of its schools, he was wondering whether or not it was already there or did it kind of catch up later. It was already like that because of the schools. And that's something that, again, I did a lot of research. The Bell School District had been ranked that highly for quite some time. I think what also worked really well for my timing, and I'm probably a perfect example. So I'm like the oldest millennial, hopefully not technically, but I am technically a millennial, but I'm like the oldest millennial. And most millennials wanted to live in big cities. And as we started to have children, we were not willing to just quickly run off to the suburbs. So in a city like Chicago, where you have people who move to the city to be in Chicago, there was less desire to go live up in Schaumburg or wherever else. So the schools for North Center were very, very appealing for folks like myself. As a matter of fact, there's kind of a joke in that community that you had a lot of people who used to live in Lincoln Park when they were younger in their 20s, and then once they started having school age kids, they moved to North Center because they wanted to stay in a city but get the best of both worlds. So it had the reputation. I don't think we saw the migration and the demand kick up though until a little bit later, because by the time I got there, that's when you saw people, like, even the last 4 or 5 years, we just saw people buying duplexes and converting them to single family houses. So I love numbers, but you have to understand the story. Let me give you a quick one real quick. If you look at the numbers, it probably shows that more people left North Center than moved to North Center. That might indicate that there's less demand. That's not the case. What happened is there's been less housing stock because people have converted 2 units or 3 unit properties to these mega single family properties. So instead of having more units available, you have less units available. So the ones that are available end up going up in demand and rent. So if you look at the rents were certainly going up, but the number of units available in the population was actually declining. But it wasn't really that didn't tell the real story of what was happening in the neighborhood. My man Jim Biggs, what's up, brother? I didn't know you was on here, man. Jim's my guy. Daniel, can't help you with the voice. I thank my daddy for that. He's got the same voice.
All right, we got time for maybe one quick question here. Aaron, you got a quick one?
Here, let Andrew go since he didn't get to ask a question before.
All right, go ahead, Andrew.
Thanks, Aaron. I guess I was just wondering, John, could you talk about how you decided to start your podcast and maybe any advice for someone looking to start a podcast?
For sure. I'm going to drop this in here right now. I wrote an article on how to start a podcast. So I'll drop that in there with some tips and insights and some practices to get you going there. For me, it literally was this topic that we started with. I was trying to start investing in Cincinnati in particular, but was trying to learn other markets. And I was concerned I was going to make a mistake. My first 2 deals had gone so great that, and honestly, again, I'm humble enough to know it wasn't like I was some master investor. Dude, I picked great markets at a great time. To pick North Center in 2012, I mean, it was a smart decision, right? But you can't go replicate that. And I couldn't even replicate it. So for me, it was like, all right, how do I do this where I'm not just lucky? And that was the thing I was trying to figure out is like, all right, I did my homework. So I put myself in a position to be lucky. I don't take that away. I saw the data, I was looking for it and I found it. So it's not luck from that standpoint, but I knew I couldn't replicate that luck. It wasn't sustainable. So I needed to learn how to find the best places to invest. And that led me to deciding to launch a podcast. There were really 3 things. One, I needed an excuse to talk to these people. So, having a platform, again, April and Julian are doing this right now. If April and Julian called me and said, hey, John, can I get an hour of your time on a Sunday so I can ask you about this? I would have said, no. Here's my coaching program. You signed up for that, and I'm happy to answer any questions you want, right? But because they have a platform, whoa, now they call and they say, hey, John, I want you to be a guest speaker at my meetup. Oh, okay. My ego goes off. Oh, sure, I'll happily come and speak to your group, right? But that's what happens. So, and all of us do it, right? So, podcast helps you get in front of other people. You get to ask whatever questions you want to ask. Um, at the time, again, Joe's a good friend of mine as well as my mentor. He had a daily podcast, which I thought was just crazy, but he had a daily podcast. But part of the reason that I ended up trusting Joe and working with him was he had Barbara Corcoran and Robert Kiyosaki and all these other people on his podcast. So to me, that was credibility that was built in. So as I knew I wanted to expand my brand, and we didn't talk about branding, but as I knew I wanted to expand my network because I didn't have the network that could raise $1 million, I knew I needed to go create the network that could raise millions of dollars. The podcast became a part of that. So I just sent it in the chat box. I just dropped in the article that gets into specific steps to do that. But it helped me tremendously to build my brand and connect with other people.
Perfect.
John, we
Thanks,
really
guys.
appreciate your time. Thanks again for spending your Sunday with us. I'll let April and Julian go ahead and send you off for the day today.
Cool.
Oh no, I just wanted to say thank you so much again for your time. There's so much valuable information here. I'm definitely going to watch this over again.
All right. And John, if there's anything else like you want to plug, I know you'd mentioned coaching briefly. If you wanted to plug in anything else like
Drop
that.
it in the chat so that people can know where to access.
Yeah, no, look, on coaching is a one-on-one thing. So if it's a fit, we can obviously talk more about that. What I think is probably more important for everyone is two things. One is the podcast. There's a lot of great information. You can search through there for different topics, but I would check out the show. So if you got value out of this, the best thing you could do is just leave me a positive rating on Apple Podcasts. I mean, that's very helpful for us. So you can do that for Target Market Insights. And then we do have, like I said, the 35 hacks to find submarkets, as well as our sample deal package. So I dropped those into the chat box here. I'll drop them again, but just check those out. If those help you, great. From there, if we want to build and you want to do more, that's great. We could talk about it, but I would say take advantage of those resources first and foremost, and I'm happy to build on a connection and relationship from there.
Awesome.
Thank you, John.
Thank you so much.
Have
John.
a great Sunday.
Thanks, everybody. All right, you all take care.
Thanks, John.
All right, guys, I'm going to take this off record now, and then in a few minutes, we'll go ahead and just break us out into a couple breakout sessions for the next 10, 15 minutes. If you guys want to leave or if you need to leave, feel free to leave now before we go ahead and divide you guys up.